When you make projection, you have to first take the assumptions on which you will be building your financial model. Your assumptions can come from a variety of sources like analyst research, analyst models, company press releases, conference calls. There may be some information related to projections in 10Ks, 10Qs, or other company filings. In the absence of those guidance or projections, we have to rely on historical results to frame our projections about the future. So, in our case, assumptions will rely only on historical results and information available in 10Ks. So, now let us first write down the parameters based on which we are going to make the projections. So, we will be writing the assumptions for all the line items of income statement except interest expense. So, in historical analysis, we have to take only that parameter which we are going to use in future for projection. Like we will be projecting the revenue of the company based on sales growth rate. So, we will be calculating sales growth rate in history first. So, let me write sales growth rate here. Next item is cost of sales. Cost of sales we will be projecting as a percentage of sales. So we have to calculate cost of sales as a percentage of sales. Then next item is SG&A. SG&A we are projecting as a percentage of sales. So we have to first calculate SG&A as a percentage of sales in history. Then we have next item other expense. Other expense will be zero in future because that item cannot be forecasted, because there are some such items included in other expense which are non-recurring in nature. So we won't be projecting them in future, but let us first calculate it in history. So other expense as a percent of sales we will be calculating. After other expense we have stock based compensation. Stock based compensation is generally forecasted as a percentage of sales only, but there are alternative ways also. Stock based compensation is an item which comes in the income statement because of employee stock option plans. So stock based compensation should be calculated based on employee stock option plans, but that will be a very tedious calculation to do in financial modeling. And if you want, you can forecast stock based compensation based on number of employees, because employee stock option plans are given to employees. So you can find the relationship between stock based compensation expense and number of employees. So that can be one another way to forecast stock based compensation, but generally we have been taking stock based compensation as a percentage of sales only. To keep it simple, we are taking stock based compensation as a percentage of sales. After stock based compensation we have amortization. For amortization we will talk about little later. Then we have interest expense. Interest expense is also an item which we will talk about at last when we have the debt schedule. After interest expense we have taxes. Tax can be projected as a percentage of profit before income tax. So first we have to calculate effective tax rate in history. Then next item is equity income from associate. Equity in associate is a tricky item. The projection should reflect the affiliate growth prospects. It is not related with the parent company, which is Colgate in our case. So in order to make a reasonable projection, we need to analyze the investment. Typically the amount of research, time and effort required to accomplish the research of associated company is not worth, because in most cases this item represents such a minor income component and will have very negligible impact on the results. As you can see, income statement equity income in associate is just $6 million, whereas the net sales of the company is $16,734 million. So this amount is negligible. So we won't spend much amount of time to analyze the investment in associated companies. We will take a simple assumption and calculate equity income growth rate. Then next item that we have is minority interest. Again we have the same issue. Minority interest is like equity investment only. In case of equity investment, we are investor in other company. In case of minority interest, others are investor in our company. So equity investment and minority interest are two opposite sides. We will be growing minority interest with some certain percentage. So we have to first calculate minority interest growth rate in history first. After minority interest, we have common dividend. So common dividend we will be projecting as a percentage of profit. So we have to calculate dividend payout ratio in history. After common dividend, we have minority dividend. Minority dividend is a part of minority interest only. So minority dividend will be projected as a percentage of minority interest. So we have to calculate minority dividend as a percentage of minority interest in history first. After minority, we have depreciation and amortization. We will talk about depreciation and amortization in a separate video. And then we have to calculate basic EPS and diluted EPS based on weighted average shares. With that calculation, we will understand in a separate discussion.